Good afternoon and welcome to Scotia iTRADE's webinar. My name is Conleaf, the Client Education Specialist with Scotia iTRADE. I'm pleased to present to you today Seasonal Investing Strategies with Brooke Thackeray. Just before we get started, let's take care of some quick housekeeping items and then we'll jump right in. So your sound quality should be good. However, you can check the sound quality by clicking on the sound check link in the audio panel on your GoToWebinar toolbar. Now the setup window may be on your secondary screen if in fact you're using two monitors. Also, please be reminded that everyone will be muted for sound quality purposes today. Now if you're using your computer audio and you're experiencing any technical difficulties, you may wish to switch over to the telephone, give us a quick phone call by using the telephone number you see on the GoToWebinar toolbar, as well as the access code and your audio pin ID. Let's also quickly review the Toolbars feature. The orange arrow that you see at the top can be used to minimize or to open up the toolbar. If it should disappear on you, the computer sometimes does that. If you should see it go away, you can always click the orange arrow for it to reappear. Also, you can view this presentation in full screen mode by clicking on that computer icon in the GoToWebinar toolbar. Now, if you've got a question, you can raise your hand, use the hand icon to notify a question or concern, or preferably just type the question into the question panel box that you see on the bottom there, and I'll be able to interact with you directly. As a quick disclaimer, unless otherwise expressly stated by Scotia iTRADE, seminars, webinars, and other educational tools and resources, collectively called content, are provided by independent third parties that are not affiliated with Scotia Capital Inc. or any of its affiliates. Scotia Capital Inc. and its affiliates neither endorse or approve nor are liable for any third-party products or services, third-party content, or investment loss arising from any use of the content, including third-party content. So the information that we're showing today will be for informational and educational purposes only and not intended for any recommendations, advice, or taking into account your specific objectives. Also, you will be able to download, actually, as a matter of fact, I've already uploaded a PDF copy of the presentation. So if you go to the handout menu on your GoToWebinar toolbar, click on the link, you'll see the handout there provided for you so that you can follow along and make notes if you would like to for this presentation. Also, we will be recording today's session and an email link will be sent out to you tomorrow mid-afternoon. However, if you do not get the link, please feel free to email me for a copy of that recording link. I'm at education@scotiaitrade.com and I'll be able to provide that to you a little bit later as well too. Alternatively, you can always visit our YouTube channel. We've got a webinars on demand playlist there. That you can actually access some of our recorded webinars from the past. So feel free, go to our scotiaitrade.com website, scroll to the bottom where you'll see our YouTube link, click on that, and then go over to the playlist Webinars on Demand. Today I'm pleased to present to you Brooke Thackeray. Brooke has nearly 14 years of investment-related experience, most recently as president of Mount Alpha Media, where he has written and published several books, including Thackeray's 2017 Investor's Guide. He became a research analyst with Java Investment Management in 2009 and joined the team responsible for the management of the Horizons Seasonal Rotation ETF. Bruce has an MBA from York University, has several financial designations including the CFP and the CIM. So I'm pleased to present to you Brooke Thackeray at this point. I'm going to pass the presentation over to him. He will facilitate for the next 30 to 40 minutes. And then, of course, I'll join back in to provide some wrap-ups. We'll also have a Q&A as well and invite you to provide questions. So, Brooke, over to you.
Well, thank you very much, Conleaf. Today, what we'd like to do is take a look at, really what is seasonal investing, first of all, so you actually understand the way it works. And then we'd like to take a look at, seasonal investing in the late stages of the bull market and look at specific trades as well. So first of all, the upcoming decade is probably going to be, let me just go back here a little bit, sorry. Here we are here. So what is seasonal investing? Seasonal investing is really when either the overall market, like the TSX or the S&P 500, has a seasonal trend where it does better at a certain time of the year, and we'll talk a little bit about that, 6 months of the year compared to the other 6 months, or it can be sectors of the market, whether it's commodities or a sector of the stock market such as gold, banks or technology, and they're all based upon some sort of trend taking place on a yearly basis that tends to cause that to happen. It doesn't always happen, but what you're trying to do is you're trying to stack the odds in your favor, basically. So there's two goals of seasonal investing, and the first one is you want to get into a sector of the market before other investors are attracted to it. So seasonal investing really is behavioral investing, and let's just jump right in right away with this with the stock example to show you exactly how this works. Like for instance, UPS since 2000 to 2015 has underperformed the S&P 500 on average every year. But from October the 10th until December the 15th, it has actually produced an average of 8% and has outperformed the S&P 500 88%. You can call it 90% of the time. Now, it's interesting because, well, why does this take place? Investors aren't interested in investing in a company like the UPS on the margin. They're not interested in that. In the middle of the summer, they go, why would I be in there? What is causing, what would cause that particular stock to move up? And they're much more interested in investing when there's a catalyst that's going to actually help UPS outperform the market. As we know, that's the holiday shopping season, and where UPS gets really busy. And so investors want to get in there typically in November and into the beginning of December. So from a seasonal investor, what you want to do is you want to get into the stock UPS as an example. This is an example before everybody else gets in. When they all get in, you want to get out. Okay, so that's really what this is about. It's about taking advantage of the behavior of other investors as they perceive events on a seasonal basis. And this applies to the broad markets, and we'll talk about that, the S&P 500, the TSX Composite. It applies to, as we mentioned earlier, sectors of the market, commodities as well. We'll get into that as well today. Bonds, there's a seasonal period for government bonds as well, and currencies as well. The Canadian dollar has a seasonal trend against the US dollar. So we'll talk a little bit about a few of these as we go along today. First of all, on a broad 6-month seasonal trend, and most people have heard this, the saying "sell in May and go away," and a lot of people don't understand this, and they go, "Oh, sell in May and go away." Well, the stock market went up from May to October, therefore last year, therefore it didn't work. The trick is here that in the summer months, and even in this summer month, we've seen the S&P 500 setting all-time highs, but it hasn't moved up a lot, and that's very typical in summer months. You typically don't see the S&P 500 or the TSX Composite move up a lot in the summer months. So even though you may see some positive returns in the summer months in the stock market, they tend not to be large. But on average, it's best to invest from the dates that I use is October 28th until May 5th. And if you invested $10,000 in the S&P 500 in 1950, you would have ended up making $1.4 million. If you invested from October 28th, sold May 5th, held the cash, went back in next October 28th, and then sold the next May 5th. That compares to the other 6 months of the year, from May 6th to October 27th, whereas if you invested $10,000, you would have lost $2,000. So in other words, this one 6-month period, which is from October 28th to May 6th, tends to be better than the other 6 months of the year. So, buy and hold strategies when you just leave your foot on the accelerator and you hold it down in one place. You don't adjust for any seasonal or any other risk tendencies in the market. Whereas what seasonal does is says, well, yes, the market, long term, and the market goes up, but it tends to do better in the 6 months from October until May. And we can see that here in this diagram here. This is the average for the S&P 500 from 1950 to 2016. You can take a look here. The S&P 500 has outperformed in its seasonal period from October 28th until May 5th, and it's generated an average of 7.8% as well. And so how do you handle this process? Now, there's opportunities, by the way, in the summer months. You can be invested in a variety of different sectors in the stock market, different commodities. But from a seasonal perspective, the way you want to do it is you want to be invested overall from October to May. And so if there isn't some enticing opportunity from a seasonal basis, you're invested either in the TSX Composite or the S&P 500 as a core position. And when sectors come up in the marketplaces from a seasonal perspective, you want to rotate a portion of that into that seasonal trade. When that seasonal trade gets done, then you rotate back out into the broad market. So you're staying fully invested in that time period versus from May to October, the core position is cash. And yes, you can be in utilities and biotech and gold stocks and a number of other ones. But if there's not enough of opportunities in the seasonal sectors, you're actually holding cash as well. So it tends to be overall, you tend to be more conservative. Let's just go back and take a look. Here we've been in the bull market for the S&P 500 since 2008. If you take a look at the blue shaded areas, now this is a bull market, right? So I mean, the market's done very well, and buy and hold, the S&P 500 has done very well at the same time. The blue shaded areas represent the favorable 6 months, and the gray shaded areas represent the unfavorable 6 months. And you can see here that on a yearly basis, even though the stock market has moved up in the 6 months from May to October, what's important here is that in almost all the cases, the favorable 6 month period has been stronger than the unfavorable period. And that so far applies to this year as well, this particular cycle at the same time. So it's not just about, oh, here's some calendar dates, and I write a book every year, and I'm updating my 2008 to 18 book to come out shortly, and adding some new sector trades and stock trades as well. But it's not where you go, oh, this is where I have to buy, UTX or TD Bank or whatever it is on such and such a date, and then I sell on that. It's a combination of saying, well, this is the general average trend, and you want to adjust it based upon technicals, and maybe there's also fundamentals that influence that as well. And typically, what you might say, well, retail is getting is really poor, but that will also show up in the technicals. So the way to really apply a seasonal trade is to say, here's a seasonal period, and you either enter a month early or a month late, or on the exit side, and exit a month early or a month late. And if it's not working, the trade's not working, it's underperforming the market, then you get out. But the point here is the dates, although they represent the average, you want to fine-tune the dates as far as the sectors of when you should be getting in and getting out of the sectors or stocks. If we take a look at the late stages in the bull market here, so it's very difficult to say that it's over the next 8 years we're going to have the same gains in the S&P 500 that we've actually had in the last 8 years, given the low growth environment that we're in, high valuations, etc. And nobody knows what the stock market's going to do, of course. But we're probably, here we are in the third longest bull market, at high valuations and in a low growth environment. So we're more than likely going to see some sort of slowdown, and this is really when you want to, when you're actually applying an alpha strategy, you're going to be rewarded for it. So there's low probability of similar large stock market gains coming up that we've seen over the last number of years, and so we have to look for something a little bit different than what's taken place. Seasonal investing has actually worked very well in the last 8 years, but the expectation is that it's actually going to work even better over the next period. If you take a look at where we are right now, the period here is, here we've had this rapid bull market, but if you compare that to the period from 1966 to 81, which is, a flatter market, in that time period, seasonal investing actually worked even better than what it is today. So there's a lot of ups and downs in that time period, and that's true because when the stock market's flatter, the divergences that you can provide from alpha trading strategies are going to be greater, including seasonal investing. And as I mentioned earlier, seasonal investing is readjusting the risk based upon seasonality, saying, I want to decrease my risk in the summer months. I'm still going to be invested in different sectors of the market. I want to decrease my risk in the higher beta sectors at a certain time of year based upon their seasonal performance. And I want to emphasize the more defensive sectors at a certain time of the year. And that's really what it comes down to, is risk management. It's not just, here, this is when gold tends to do well, put all your money into gold. You still have to maintain the overall portfolio management and say, well, we need a number of diversified sectors or positions in investing, and and make sure that that's the overall portfolio mandate that you're working with in order to control risk. But it adds another layer of risk reduction and risk control as well. In down markets, you're going to see less correlation with compared to bull markets. In bull markets, you might see the a strong run in a particular sector, but in a down market, you are going to see one sector do well at a certain time, and another sector a lot more rotation. But I mean, bull markets, there's rotation that goes on, and you might in the stock market and areas, we've seen technology do particularly well recently, and which is really done well. And we see a lot of money coming out of the other sectors into that particular sector. Recently, it's actually pulled off a little bit here. But in a down market, you're going to start to see more shorter divergences in trends, and this is actually going to help with seasonals, in the sense that gold's going to do better typically, or it would be expected to do better in its seasonal period than industrials would tend to do better in their seasonal period as well. And we haven't seen this over recent years. We haven't seen that large extra alpha provided by seasonal investing. It has performed well, but we'd expect to see even more so. And cyclical and high beta sectors tend to have shorter periods of seasonal outperformance as compared to a bull market. So that's going to help, because instead of just saying, oh, we need to be in technology and staying there, you're going to be in technology, and from a seasonal perspective, you're in technology at the right time, so that you can rotate into something else a little bit later on. Current and upcoming seasonal trends. So here's one with natural gas, and natural gas does well. And just to go back to my example with UPS earlier, with UPS, I said you want to be in, right, before all the other investors want to be in, get into that particular stock, looking for a catalyst, waiting for the catalyst to move the price of that up, and then you want to get out before that happens. And before we move on to natural gas, let me just give you another example. Retail. The retail sector is actually being, obviously slammed really hard because of online shopping, and but the retail has a seasonal trend. And if we use the same premise of what I did with UPS and apply that to retail, the busiest time for retail is in the fall time, and the big day for retail in the States is Black Friday, so towards the end of November. So what you want to do from a seasonal basis is you want to be in retail in October, and when everybody else gets in just before Black Friday, you want to get out, basically, so you're capturing that benefit taking place. And that's really what it comes down to. Now, retail may report stronger numbers and do really well after, but on average, it's actually been better to just get out Black Friday. So that's what you're doing. You're taking advantage of investor behavior. Natural gas is exactly the same. There's obviously injection seasons and withdrawal season and inventories you have to worry about and everything else, but it has a seasonal trend. So here we're looking at natural gas, overall seasonal trend for natural gas. There's two periods where we use natural gas. One is for heating and one is for cooling. Cooling, we use natural gas to run create the electricity in order to run the air conditioners. And that's exactly what you see here in this chart. If you take a look at this particular chart here, you can see here that, I'll just draw it here. You can see here this run-up that's taking place. Oops, let me go back. Change that. Okay, depend. And now we can see that this run-up that's taking place on an average. Now this is the average year for natural gas from 1995 to 2015. Every year is different, but this is one year laid upon another year. And sometimes it'll go down from March 22nd until June 19th, and sometimes it'll go up. But on average, this is what's taking place. So natural gas hasn't performed well in the summer months when it's actually being used, right? And the same thing with the heating. The natural gas price has done really well, not in January and February, okay? It hasn't done well at that time. It's done well in the fall time, and that's exactly where we are right now. So the period for natural gas, and this is has performed extremely well from September 5th until this December 21st. Now, if you take a look at the overall rate, October tends to be a strong month for natural gas, and November tends to be a strong month for natural gas as well. And once you hit December 21st, well, why December 21st? And this is another example of seasonality on a more micro level. And December 21st, in my book, I outline that and show that natural gas tends to go down from December 22nd until the end of the year. Well, why is that's almost like getting really micro there? And there's a reason for it, and that is a lot of the companies in the States, depending on where they lie in the States, but they have to actually pay tax on their natural gas inventory. So what do? At the end of the year, to avoid that tax, they try and dump that into the market, as much as they can, and so it actually depresses natural gas prices. So you tend to see that pull off at that time. So once again, we're in this seasonal period for natural gas, and natural gas we've seen around just over $3 on the spot price. It's been hovering around here for a little bit. It's actually pulled back down. It was higher before a few months ago. So that's actually a good setup on a seasonal trade. That's one of the things you want to look at when you're doing a seasonal trade, is if you're coming into the seasonal period for a sector, stock, or commodity, and you've seen that pullback take place and you've seen a market perform, then that's actually setting up well, because sometimes it gets a little difficult if you've seen a stock or sector run up strongly before the start of the seasonal period. Then you can still go and still do well, but you have to be a little bit more careful. So right now natural gas has declined in price. In fact, if I'll just draw out if we take a look at the overall pattern over the last few months, we've seen this pattern that's gone like this, up and down, and getting smaller and smaller. And this is all right here, formed a nice layer of support, and here we're at, in this case, was around $3 to $3.10. Okay, and we're currently trading just above $3. $3.10 is really the breakout level for natural gas. So we have seen some stability here at the beginning of the seasonal trade, which is actually a good setup. Natural gas is obviously a very volatile commodity and a very risky investment as well, so investors have to be cautioned on that as far as investing in natural gas. Gold bullion. Gold bullion is a really interesting topic. Not everybody, but quite a few people are talking about gold right now, and is it going to go higher? And the Fed's changing direction, and how's that impacting everything? So from a seasonal basis, gold actually does well from gold bullion from July 12th to October 9th. Now that last little bit for gold in October is really iffy. And if you see any weakness from a seasonal basis, you tend to want to actually start stepping out of that. And gold bullion, why does it have this seasonal pattern? Well, it's the demand takes place really for gold, as actual from a consumer level in the fourth quarter, whether it's the Indian wedding season. Also, our Western society, the highest amount of gold we consume is actually in the fourth quarter as well. So and on an aggregate basis, that's where the demand takes place, but the fabricators need to buy gold. That takes place months earlier before that takes place. With supply being constant, you tend to see this demand-supply imbalance, and we see this rise in gold here at this time. So once again, this is gold bullion, the average graph from 1984 to 2015. You can see here that really this is the rise that we're looking at. There is a caution, and down here I've got this relative to the S&P 500. And so even though you say, well, look, gold looks like it goes straight across here, look, yeah, maybe it's okay, but really if there's other options out there, because this is relative to the S&P 500, when this line's moving up, that means it's outperforming the S&P 500. When it's moving down, that means it's underperforming. And so with you say, well, if I can make more money somewhere else, then on the margin in a portfolio, you say, well, maybe I'll make that adjustment and move on. From a seasonal basis, I can tell you overall October has been a weak month for gold. And there's been a reason for that historically, and it doesn't really apply so much now, but the trend has continued. Historically, what took place back in the 1990s was that central banks were just dumping gold into the market in October. Why? Because initially they were just selling, they were big, huge net sellers of gold. They didn't believe in gold, and they were selling it and really damaging the price of gold. And they got together and said, let's form an agreement and determine who can sell how much gold each year. And we'll renew this every year on a 5-year contract. Well, that started each year on October 1st, and so they used to just sell into the market when they got the new allocation, which would drive gold down. But gold still has, even though central banks now have been net buyers of gold, we've still seen the same trend, with October being one of the weaker months for gold as well. So just a caution, gold's done well in its seasonal period this year from July 12th to October 9th, but it's just a caution for that as well. So gold's done well in the seasonal period, but we're at the end of the seasonal period, and typically what you want to do is you want to set up some parameters, a stop loss, and say, okay, we're close to the end of the seasonal period. If it breaks this level, then we get out. Right now we were trading in a trading range before between 1,200 and 1,300. We're back below 1,300, which is a signal of weakness. So something to consider as far as a gold bullion. And gold miners themselves as well. Gold miners have a very similar seasonal period to gold bullion. I used to get asked a lot, years ago, when are gold miners ever going to outperform gold? And that was a lot because of what was happening with the mining operations, and they had overexpanded too much and paid too much for each other's stocks and everything else. But gold miners, they really go from July 27th until September 25th. So about the same time, a little shorter. So we're actually finished the gold miner seasonal period as well. Just a little bit of information on that. And if we take a look here, we can see here the real spike from a seasonal basis is really right here in September. Okay, and that's the average and the median quite high. And you can see here October tends to be one of the weaker months for gold as well, something to watch out for. And this is from 1984 to 2016. And if we take a look here, this is over the last 5 years, and here we are again here with October being one of the lower months of the year again. So the trend has persisted over the long term and the medium term and the shorter term as well. So something to watch out for as far as owning gold coming up shortly. And we've seen gold this year have that strong rally, of course, and it's done well this year since the beginning of the year. And that's a trend that actually, and some people say, Brooke, you know what? Are there any seasonal trends that do change over time? The driving season for oil, driving hasn't changed. We drive at the same time, we heat homes at the same time, so the same drivers are there, so you see the same trends. And for most sectors of the stock markets, whether it's the retail sector or the technology sector, they have the same trend that's taking place. Gold has changed a little bit, and just something to watch out for, in the sense that 15 years ago, China, as private citizens, really couldn't buy much gold at all. They were quite restricted. Now that's totally changed. And now they're able to buy gold. China's actually huge buyers, up to equal to India as far as buying gold. So you're starting to see a little bit of a blip in January and February coming into their Chinese New Year, right? So once again, because that's when they buy most of their gold, the average consumer. So something to watch out for. If we do see a correction take place in December, and this applies to silver as well, you might see a little bit of strength in gold in January and February. From a seasonal basis, our preference in January, February, and into March would be silver, especially if silver actually gets hit very hard. And I've written about this in my newsletters as well. Over the last few years, we've seen actually silver do exactly that. We saw that last year in 2016. We saw it in 2015, 2014. Silver actually hit hard coming into the end of the year and provided an excellent opportunity to do well over the next little while. Canadian dollar. Okay, so wow, it's been in the news a lot recently, and it has a seasonal trend. And if you take a look at the Canadian dollar, you see, look at this graph here, this top graph here. We can see the best month for the Canadian dollar, and I go into a little more detail in my 2017 book on this, but I actually break it down by decade, the performance as well. But the Canadian dollar, actually, the best month of the year for the Canadian dollar is April. And that's actually worked 12 out of the last 13 years. And this year was one where it didn't work, actually. So the Canadian dollar, despite its recent strength over a number of months, didn't outperform the US dollar in the month of April. But that's typically when you want to take a look at being long the Canadian dollar, right? That's the strongest month. It can be strong at other times. Actually, we do see another smaller seasonal period from the end of July into the beginning of towards the end of September, which we just finished up, and that's actually performed well. The worst month of the year is on an average and median basis is, and also on a frequency basis as well, if you combine them all overall, November is definitely one of the worst months of the year for the Canadian dollar. So something to watch out for. Here we are trading above 80 cents for the Canadian dollar. It's done really well. We can talk about the fundamentals and say, you know, there's a reason for this, and compare the US dollars to other currencies. But on a seasonal basis, the Canadian dollar tends to underperform. Really starting in October and into mid-December. And you can see here, once again, January tends to also be a weak month as well for the Canadian dollar. So despite the Canadian dollar actually doing well recently, you know, we're coming up to a period where the Canadian dollar tends to underperform. If we take a look at, you know, what causes this? Well, first of all, there's a lot of variables that affect the Canadian dollar: interest rates, Canadian monetary policy, you know, FX crosses. Now, there's a whole bunch of things, but one of them is seasonality. And from a seasonal basis, the Canadian dollar is influenced partly by the price of oil. And that's, if you take a look, this actually, April is the strongest month for oil, all right? And October tends to be one of the weaker months for oil. Now, it doesn't have to be that way. And in fact, I've done a correlation study before. Even when oil doesn't improve in price in April, the Canadian dollar has still performed well in April. So, I mean, something to consider. Overall, so maybe we do have a little bit of a slack here as well. And what this doesn't, you know, you may have a viewpoint on the overall U.S. dollar on an 8-month or 8-year cycle or something of that nature, and say the U.S. dollar is going down. But where, you know, I'm trying to show you is say, well, this is when we tend to find, even in those bigger cycles, you would find that the Canadian dollar would tend to do better in April and tend to do poorly in November. And right now, while we've rallied strongly, right? So we're up to resistance, basically, just under resistance. People have different rates for that, but if you take a look, we're just trading above 80 cents right now. I have resistance at 84 cents for the Canadian dollar, and we could. And the bottom end, you're really looking at 72 cents. So from an upside, here we are fairly close to the resistance level, and we're close to the time when the Canadian dollar tends to actually perform poorly relative to the U.S. dollar. I know today, the governor of Bank of Canada, Paul Laws, basically came out and sort of said, well, we're going to feel our way around based upon what's coming up. So he backed off of this a little bit, seemed to be a little more cautionary. And so, the Canadian dollar is down today in particular, but it's something to consider overall on a trend. So you may say, well, look, we're still going to be more hawkish than the U.S. Overall, but from a seasonal basis, we tend to be a little bit weaker at this time of the year. So, I mean, in the end, seasonal trades, really provide you with a sandbox of where you can actually take a look to invest. So, if you're saying, well, I want to be in the energy sector, when does the energy sector tend to go up? It's going to go up and down at different times of the year, of course, and you're not going to get every rally, and you're not going to be there for every downturn as well. So you're stacking probability in your favor. So out of a whole bunch of sectors of the market or a whole bunch of stocks, you say, if I want to buy UPS, when's the best time to buy UPS? If I want to buy Disney, when's the best time to buy Disney? Based upon their seasonal patterns, based upon some sort of underlying causational factor. And that's what seasonality really does. And it just helps you to become aware of, well, maybe Canadian banks tend to go up. In fact, the seasonal period for Canadian banks is from October 10th into the end of the year, and I've written about that in my books as well. So, I mean, and that's based upon, well, why do Canadian banks go up at that time of the year? They can go up at other times, and they're solid investments over time. They've proven to be substantial investments. But that time of the year in particular is because their Q4, their full year earnings comes out, their fiscal year end is October 31st, and they come up with their earnings usually towards the end of November. And so investors want to be there for that, and they tend to get into that particular sector as well. So that's what seasonal investing is really all about. It's, an average trade length of about 2 to 3 months. You're trying to get into a sector before everybody else does. And, if you're a long-term buy and hold investor even, you can still apply the principles of what we're doing. Say, well, this is a good time to get into chemical stocks. This is a good time because it's always nice to start a trade on a positive footing. You know, it doesn't always work that way for everybody, of course, and everybody has those trades where you get in and despite you believing longer term, it might go down at the beginning. Well, this is at least stack the odds to give you a little bit of a boost at the beginning. So the seasonal strategy helps to reduce risk, can be used by everybody, even no matter what you're using. If you're using other technical trades for this, where you're using swing trading or whatever it is, you can still do this. And how you combine that is to say, well, this is the time when I'm going to look for these particular stocks. This is the time when industrial stocks tend to do well. Or here's some certain stock names, they tend to do well. Let me see if I can apply whatever other methodology that I'm using. And there's our disclaimer on here, so for educational purposes. And I'm going to finish off at this level and wait to see if there's any questions.
Great, thank you so much, Brooke. It was interesting information, and I'm hoping that it's going to assist us in our investment journey. Now we're going to have a bit of a Q&A session, so if you'd like to just type in your questions, I'll be able to present those to Brooke, who will be able to address them for us. All right, here is one question now. Let's take a look at that. Jeffrey's asking, you referenced oil, but could you speak more focused about oil's seasonality?
Sure, okay. So oil has two seasonal periods, and the main one is actually from February 25th until May 9th. So what drives that seasonal period? It's the summer driving season. The highest usage of oil takes place in the summertime. And so that's really going to have a draw. So the refiners basically in winter, late winter, they start shutting down the refineries, doing the maintenance on the plant, switching over from winter gas to summer gas in preparation for the driving season. And then you have this pull that tends to happen for oil, which drives the energy sector up at that time. So from February 25th to May 9th. There's a secondary seasonal period, which is from July 27th until October 3rd. It's not nearly as strong as the other seasonal period, and it tends to perform okay when you've seen the oil sector actually fall down substantially, and that's exactly what took place this year. So we've seen a protracted downturn for the the energy sector, and from July until up to today, the energy sector has actually done quite well. But the main trade for oil that you want to take a look at, that sandbox I'm talking about to play in, is from February 25th until May 9th.
Great, thank you so much. Jeffrey, I hope that was addressed your concerns there. No other questions at this point. If you do have questions, oh, here we go, there's another question. Jeffrey, no, thank you. Jeffrey says thank you.
Oh, okay.
Okay, yeah, great. If there are any other questions, please feel free to jot them down. I'll just do some quick closing comments, and if there are any questions in the interim, I will pass those over to Brooke. So let me transition back now to the presentation. And I'll keep an eye out on the questions. Okay, so what's next? You can access the webinar recordings, as Ed mentioned, on our YouTube channel. The YouTube channel, of course, I'll show you where that is in a minute. Or you can email me at education@scotiaitrade.com to request a copy of the recording link here. Now, after you exit the webinar session, as usual, we will populate your screen with a short survey. We just ask you to spend a few minutes letting us know how we did today. If there's any other educational offerings you'd like to see, just let us know that as well, and we'll try our best to accommodate you on that. The webinars can be found under the ScotiaITRADE.com site. Scroll down to, or click on the Education tab, and there you'll see the events calendar. Scroll to the bottom of the screen, you'll also see the YouTube link there. So let me just check one more time for any questions. Oh, yeah, there is one other. Ah, yeah, Fox says thank you. Okay, great. Well, thank you as well, everyone, for being with us today. Thank you, Brooke, for a great presentation. Thank you for your time with us here. We're hopeful that the information presented is going to help you with your investment journey. And if you have any other questions or concerns, please feel free to email me at the education@scotiaitrade.com. I'll get over to Brooke and answer back to you as well too. On behalf of Scotia iTRADE and the client education team, have yourself a really good afternoon, and we'll see you shortly. Thank you, everyone.